when you understand the simplicity of it and the power of it, it's just a wise decision to
Yeah.
jump that one step. Hi, everyone, and thank you for joining us here. I'm Ray Ward, and our other host here, Kyle Reese. I'd like to start off by saying we'd love to have you bang that bell and subscribe to us and share this podcast, because there's a point in this chapter that we're going to go through, starting on page 41. On 43, Nelson says, this is the essence of IBC, becoming your own banker. So anyway, take it away, Kyle. How would you like to start it off today?
Man, he starts off talking about the All-American man. And I think that's really important to recognize, is that infinite banking isn't for the wealthy only. And I think a lot of people come to this concept, or they hear about it, I should say, and they don't give the book Becoming Your Own Banker its worthy time. And so they have this opinion that overfunded life insurance is only for people who can spend a lot of money because they make a lot of money and they've got just a bunch of excess cash. Nelson talks about how this is for the average guy. And I love that about Nelson. And so as we're going through this section, I just wanted to maybe take one step back and say what really is going on in this section of the book. We're talking about how to start building your own banking system. This is pages 41 through 47 of Becoming Your Own Banker. And I would say, if we're going to back up and take a 30,000 foot stab at this, 30,000 foot view, whatever.
No, you had a good.
That was good. All that's really going on is we are comparing the various methods of financing. And back on page 14, Nelson says that the infinite banking concept is just an exercise in imagination, reason, logic, and prophecy. Imagination being the most important element. Well, in this section, we're going to dive into the reason and logic portion. And so keep in mind, this is super important. But again, this is only as important as you will allow your imagination to run. And so don't forget about that, but also just tune in to, maybe it might be boring for you, but to me, this is the section that changed everything for me. So tune into the reason, tune into the logic, allow yourself to be impressed, not by Raymond or I, because you'll probably not be, but allow yourself to be impressed with the simplicity and also the thoroughness of Nelson's work.
Yeah, I mean, he had a lot of experience with people that were naysayers, so he got really, really clear about everything around it. You know, like the simplicity of it is one thing, but everything that's around it, the way people think, you know, the thievery, and all that stuff. I'm looking back through the book while you're talking, and I'm looking for that chapter that we did. Oh, there it is, on page 17, where he talks about what the problem is. And so I think that it's that people, if you listen to what we're going to talk about today, and you go back and listen to when we made the podcast on the problem, which is again on page 17, you got to have an understanding of what the problem is, and then you'll see the brilliancy of why this, IBC, if you do it through the life insurance company, the mutual insurance company, why it is so powerful over time, So anyway, sorry to go off on that.
No, I appreciate that. No, and just a quick plug for that episode. That one was episode 15, titled "Death by 1,000 Cuts." That's where we talked about the problem.
Whoa, boy,
it's so easy.
That's creepy. I'm in a mood today.
Words, yeah, there we go. Wordsmithing podcast episodes. We gotta just make it spicy for all of you listeners.
Yeah.
Anyways, one of the things that I like about this is that he starts off talking about the problem, and he addresses that the mortgage is where you lose most of the interest, and it would make most sense to focus on that first. However, not everybody can do that. Actually, very few people can do that because of the nature of what we've got ourselves into. And so the recommendation for this section is to basically start small and then finance your way into the big stuff.
Right. Yes. As the snowball grows, right? Yeah.
Yep.
Eventually you can get to the point where you could excommunicate your mortgage. You could knock it out, and then you would be sending your payments to yourself, your own banking system. But it takes time, and I think that Nelson knows that everybody's driving a car, and there's lots of different ways of financing it. And there's 5 examples here in the book, but he also mentions a couple others. If you watch his 6.5 hour thing, where he does his workshop, and he talks about you could steal it. You could steal your car.
The easiest way.
Yeah. But eventually you'll get caught. Eventually you'll get caught. But anyway, so leasing is the first one he mentions. Oh, did I jump in front of you? There was any more you wanted to say about?
Well, let's just set the scene really quick. We're dealing with the All-American Man, and we're not going to necessarily dive into all the values. If you really want to do all the math, go through and read it for yourself. But
right.
One of the things that is important to note is we're financing vehicles. We're looking at at least in this section of the book, he's looking at a 44-year period of time, and they're replacing the vehicle every 4 years. Why are they replacing the vehicle every 4 years? That's the American national average. Okay, that's what the All-American Man does. Some people are like, I would never do that. Totally get it, but you might do it every 5 years, right? So again, just use your imagination. These are the numbers that Nelson picked. One of the other benefits to replacing your vehicle every 4 years is you're preventing a lot of increased maintenance costs as the vehicle continues to age and age and age. So it's just really staying on top of something that's going to happen no matter what. If it, for you is a smaller interval, again, don't worry about it. But yeah, Raymond, why don't you start off talking about the leasing section?
Yeah, so the leasing section, he's mentioning it as method A, is the most expensive. And really all you have to really think about is that that's a person that has a car to lease to you had to put capital out to buy that car, and they are going to want to get that back as much of it as they can, as fast as they can. They may not get it all back depending on the length of time for that lease, but it's the most expensive. But also, it's a growing trend, which is, it's not a good signal,
right,
to the American economy.
Have you looked up today's stats on the trends of leasing vehicles?
No,
I looked it up, and it's kind of confusing because there's some people that say that it's more, there's some people that say it's less. But ultimately, whether it's a growing trend today, it was a growing trend at the time that Nelson wrote this book, and that's kind of what he was addressing. Is like, hey guys, pay attention. When you're paying this off, you're paying the owner back and the banker, the financer, and anytime you're going to pay more people for the same thing, you're just adding dollars, you're adding interest, you're adding cost to the same utilitarian use, right? You're not getting any more benefit. You're just adding more people that you're paying. And so
Yep. Yep.
Maybe that's not
And
the wisest thing to do.
well, yeah, and also you end up with nothing at the end of it.
Mm-hmm.
You had the pleasure of driving in a new car for 2 or 3 or whatever years you've had it, but you end up all the money's gone forever, and the car is now gone if you didn't buy it out.
Yeah.
So, and go ahead on the second one. You want to start on the second?
Yeah, yeah,
Um,
absolutely. So the second, or method B, as he calls it, is financing through a bank. So we're not leasing anymore. We're actually purchasing the vehicle, but the bank is going to purchase it for us, and then we are going to pay the bank back. This is more affordable than leasing the vehicle because you're not paying a second owner. You're not paying the owner of that car because you are the owner of that car. Uh, so you're only
right.
having to pay the cost for the financing, and eventually you'll own it. So you can trade it out for value. Um, that's great,
Mm, mm.
but
Yeah,
it's
yeah.
still costly.
Yes. Yep. Um, and the next one is paying cash, and a lot of people talk about paying cash, and it is probably better than taking a loan. But you're just going. I have a little prop. I'll just see if I can run through here. So for those of you that are just listening, I'm just going to say that I'm holding up a prop that shows somebody saves for, uh, let's just say they start off by saving for 4 years. They save, they save, they save, and then at the end of that 4 years, they take out X amount of dollars. Let's say they take out $10,000 out of the account and their savings account, and their savings drops right back down to zero. And so that money that was in there growing in their savings account is no longer making any interest from the bank. So, and then they have to start all over again. And I'm going up and up some stair. It looks like a staircase. I'm going up, up 4 years later. They trade in the car and they have the cash, but the car is probably more expensive 4 years later to buy the new one, new used one, and they take the 10,000 out again, and it drops right back down to zero again. And so it's what do we call that? Am I correct in calling it sunk cost?
Yeah, sinking fund.
Sinking fund. That's it. Yeah. And so we're going to put a little picture of this prop that you can go and look at later, so you can see what we're talking about here.
Yeah, I appreciate that. And so basically, one thing that's really important to remember with the cash is it's no different than methods A, B, D, or E. You're still making payments for a vehicle. I think a lot of people who are big fans of using cash, they like the fact that they're not making payments. They're never making payments. They're always just taking their
yeah.
cash and going and buying a car. Well, you're still making payments. It just depends on where those payments are going. If it's going to a commercial bank, to the leasing company, or to your own savings account, you're still making payments. It's important to go back to Nelson's original comment where he said, we finance everything that we buy. And if you, a lot of folks who think along the lines of using cash for everything, that's the thing that they miss. They miss that they're still financing it and they're still making payments. They're just making those payments to a different place. One of the things that's really good about the cash method is that it requires discipline. You have to have that self-discipline, and you have to so you're going to be beating Parkinson's law, which is great. um,
Yes.
the only problem is it's very difficult for most people to maintain that self-discipline. You might have it for 4 or 8 years for your two vehicles or whatever it might be, but then you have a kid, then you get married, then you have 10 kids, whatever, however many you want to have. But the costs continue to you continue to accrue more and more and more costs, and so then you'll let some things slip by the wayside and forget that, hey, you still need to make a car payment, because the car that you have right now is eventually going to need to be replaced. None of them
Mm,
last forever.
right. Right. Yeah. Yeah. Really good point, Kyle. Really good point. Yeah. Yeah. You're saving in any one of them, whether you're sending it to a lease and yeah, you're saving. Yeah. So,
The cool
um,
thing with this cash method, sorry if I interrupted you. I'll
no,
just
no,
finish this.
no, go
But
ahead.
the cool thing with this cash method is you're on the right track, right? You're starting to think and approach money as a valued thing. You're not going to get something that you haven't earned yet. You're deferring your use so that you can build up your own capital to then go have the thing that you want to have. Whereas the other two methods, leasing or purchasing from a bank, you do not have to you don't have to wait. You can do it right away.
Right. Yeah. Yeah. The, the one other thing I would just mention too is that when you're doing that discipline of saving, you are just one step away from doing IBC. That if you
Mm-hmm.
did the same thing for 4 or 5 years to save for that car through the policy, it would be a completely different animal.
And there's even
Correct?
some things about the infinite banking concept that actually make it easier than paying with cash because it removes that Parkinson's law tendency that we all have. It prevents some of the Willie Sutton types from accessing what you might have. So there's a lot of things that infinite banking actually provides some barriers of entry into that protects your capital a little bit more than the cash does, which just makes it easier when you think of it as financing rather than just like, hey, I've got cash, I'm going to go use it. Um, it makes you be a little bit more intentional, which to some I understand. It that doesn't sound fun. It doesn't even sound easy. But trust me, when you're in that situation, of having to continue to tell yourself no over and over and over and over to a big old pile of cash that's creating a lump under your mattress because you know next year you're going to need a car. You're sleeping on that cash. You know it's there. You feel it every single day, and you're having to tell yourself no every single day or every single month. That's not fun. That
Right.
wears on you, and it's all
Yeah.
subconscious, but it wears on you.
Yeah. It's very subtle. It's like looking at your checking account and you know, maybe you got paid, maybe you're married and your spouse got paid and this flow of cash comes into your checking account. It's much easier to spend that because you can see it. And
Mm,
like what you're saying is that you can feel it because you're laying on it at night. Um,
yeah.
that also is kind of difficult, you know, laying on it with a checking account. But it's the same thing because you can see it all the time. You look at it and go, oh yeah, look at all the money we got in there. Let's go do something, you know.
Yeah.
Where when it's in the policy, you take pause. I guess there's a chance for pause to think
Yep.
about it, and like you said, be intentional. So,
Yeah, absolutely. One of the one of the things that would be a negative with the cash side. I mean, there's positives with the cash side, but one of the things that a lot of people don't think about from the cash perspective is that there is a cost to money. And when you're using cash, most people have this feeling it's like, oh, there is no cost to my money because it's here. It is a simple transaction. Nobody's charging me for that transaction. I'm not paying any interest, all that kind of stuff. Well, no, you're losing interest that could have otherwise been earned if you had
mm,
put that money into an environment where it would have been growing. And we'll talk about that in method D. The other element is you're saving that money in a stagnant environment. So nothing's happening, no growth can happen. Uh, Literally nothing's happening to your cash. It's sitting there, it's staying there. Nothing positive is moving. It's and Nelson talked about the value of motion. You know, motion is a law of God. Air has to move, or it gets stagnant. Water has to move, or it gets stagnant. Blood has to move, or else we die. And
mm,
it's when you put your money in a spot where there's no movement, it becomes less valuable in time, especially
yeah,
when we go into eras of inflation, which I don't think we're ever going to be out of that, honestly.
Mm. Yeah. Um, yeah. So, and then the next method is the CD one, where he actually goes into it a little bit in more depth and lays it all out. And again, we won't get into the numbers here so heavily or anything, but in on page 41, you can see all five of these things, these methods, and you can see how one is better than the other successively.
Mm-hmm.
And even the cash is just a little bit better than using a commercial bank. And the CD, he's talking about a CD inside of a bank and doing the same thing. So you're getting a little bit more interest than maybe just the saver that's paying cash, saves in a savings account. And then, so the example is just one step a little bit further and saying, instead of just putting it in a savings account, someone is going to put it in a CD where they get a little bit more interest. Um, so that's method D,
And
using the CD. Go
yeah,
ahead.
and one of the things that this does is it forces you to start capitalizing. It forces you to start thinking more long range than even cash, right? Because there's immediate access to cash. You're just saving up however you save up. Well, with a CD, you have to go into that saying, "Hey, this is the car that I want. This is when I want it." And you got to kind of set up a plan and know if the amount of money that you're going to put into that thing, growing at the interest rate that they say it's supposed to grow at, is going to provide enough capital for you to then utilize to purchase your vehicle. And so this is the first of all of the methods that actually really addresses the need for capitalization.
Good point. That is a really good point. Um, how far do you want to go into this, Kyle? Why don't you take the lead on this, if that's okay with you?
Yeah, absolutely. Well, I think there's a lot of meat here, and I don't want uh, to short any of our listeners. I don't want to get into all of the weeds, but one of the things that he does clarify is when you're using the CD method, you're putting your money into someone else's banking system to do it. That's totally fine. It actually makes the CD method more efficient than the IBC method in the initial years, in the first 14 years, according to the illustration in the book. The only problem with it is when you're handing over your resources to somebody else, they're the ones that are going to profit on the management of those resources. So if they go out and lend those monies out to someone borrowing, they're going to charge interest, and they're going to profit on that. The stockholders of the bank are the owners of the bank, right? Those stockholders are going to be earning all of the dividends, whereas the owner of the CD, or the depositor, is going to make the interest that was advertised.
Yes. Right. Yeah. So go ahead. Go ahead. You look like you want to continue.
No, you're fine. Go ahead.
I was going to say that. So if you think about the person that's got a CD going, and even in today's environment, I don't know what CD rates are, but I'm gonna guess that they're somewhere higher than they haven't been in the past. So maybe, depending on how much money you put into it, could be as much as could I say 5% in a CD,
Yeah,
or is
I've
that?
seen some for 5%. I've seen some for 6.5% even. But yeah, that
Mhm.
5 to 5.5% is still pretty safe.
Yeah. So you're gonna get 5.5%. But the banker that has your money now is going to loan that money out at a much higher rate. Let's just say he's going to loan it out at 10. It might be higher. So it seems like he's going to pay you 5. He's going to make 10. So 100. He's going to make 100% on your money, and he doesn't actually have anything. any skin in the game except that he has gone through the process of starting a bank, which is quite a bit of skin. But on this particular transaction, you've given him the money, and then he's made money with that money. And you could be doing that if you just did the one step difference. I'll just keep harping on that. It's just one little change. It's just one change. Run the money through the policy. But the CD is it's better than cash. It's better than leasing. It's better than putting it through a bank. So it is better.
I like what you said, and if I could go one step further, anytime we're on the precipice of a paradigm shift, we are. Let me restate that. Anytime someone has a paradigm shift, it was just one step to the side, and they see everything completely different, or one step further, and they see everything completely different. Oftentimes, we look at, here's this school of thought here and this school of thought here, and they're worlds apart. It's not as big of a difference as you might think. It's just seeing it clearly. And what you keep saying, Raymond, is it's just one step further, and you would be doing infinite banking. Look at pages 44, and at the end of the section on page 44, before the addendum, he talks about the difference in how much money that one step is worth in this particular circumstance, and it's worth a ton of money, right? So it's a fine-tuning our perspective, allowing ourselves to open up and imagine what's possible. That's all it takes for a paradigm shift.
Yeah. So that I'm just going to come right out and say the number. It's $705,000 difference over the 44 years. That's staggering. What you could have done with that as an investment over the years. What would that have really turned into if you had been investing it every 4 years? Just the extra. Every 4 years, you reinvested the money that you captured instead of having somebody else profit from it. It's more than 700,000.
And 700,000. Keep in mind, that is only the profit that the banker made on financing $10,000 vehicles once every 4 years for 44 years. That's 11 vehicles. He profits $700,000 on financing 11 vehicles. That's insane. This is why, like, the ROI, all of the investment terms, they're missing it completely. The person who controls the banking function is the person who makes all of the money. Period.
Yes. Yep. Whoever, well, like our other previous podcast about whoever has the gold makes the rules.
Yeah.
Same kind of thinking.
Yep.
But that is a big number, 700,000. But each payment that you're making, or each CD that you buy, every time you do that, they're taking that money and reinvesting it somewhere else. So the return on their investment is bigger than even the 705.
It's huge. So one of the other things I want to just touch on right before we hop into the fifth method, which is infinite banking. When you have your money in a CD, you have it in the system, in the banking system. You've turned over control of that, and you are earning your interest on the amount that you've got in there. Well, that's taxable gains. Going back to Willie Sutton's law, the IRS is going to swoop in and take their part.
Yeah.
I don't like that. I don't want that. So not only have you abdicated control over your own finances, you've also put it into an environment where all of the positive associated with it is liable for theft. And that's just not very wise. When there are other options, that's not very wise.
Mm. Yeah. When the option of coming to understand IBC, and when you understand the simplicity of it and the power of it, it's just a wise decision to
Yeah.
jump that one step to the
Yeah.
left or to the right so that the view changes. That was really good that you said that your view changes, your understanding, everything changes. Just
Yeah.
making that one move.
It's funny how simple it is. And I keep thinking, as you were talking, I keep thinking about just the visualization of the Willie Sutton's law of the IRS coming in, and just imagining some dumb conversation where uh, the bank and the government come to you and they say, "Hey, we'll take your money and we'll give you 5% interest on it, but right before we give you that 5%, we're going to take 30%." It's like, what? If it was actually communicated as it is in reality, nobody would do that. It's so dang dumb.
Yeah,
It's so dumb.
yeah, yeah,
But they get away with it all the time.
yeah. Yeah, and they have been getting away with it, and because I've lived a little bit longer than you, I've had more mortgages probably than you, and all through my life, I took on these mortgages for homes, and every time when you go to sign the papers with the bank, they say this is what you're borrowing, and they show you what you're going to end up paying, and you sign away, and it's like, oh my God, why, Ray?
Yeah.
But yeah, so um,
Well, let's talk about infinite banking. This is the best one. We've spent a lot of time already on this podcast talking about CDs and cash, as opposed to kind of speeding through the banks and leasing, because as we go through each one of these, they become more and more beneficial, and understanding some of the pros and the cons to each one of them is helpful in painting the picture of why infinite banking um, supersedes all of them. It just
mm,
blows them out of the water. He says there is no real comparison between the methods. It is shocking how much better infinite banking is. But in order to really understand that, we have to understand the four methods before that. So, um, Ray, why
yeah,
don't you take the head on this one?
yeah. So you're you're jumping ahead when you're looking at these pages. What page have I got? 40, 45. Most people a lot of people may look at the beginning years, and do the comparisons. And okay, so on page 45, 40, 46 is really probably a better way to look at it. But when you look at just the first 10 years, even, it's still, the CD is it still beating it? The CD is still beating it in 10 years. It takes 14 years before you see a shift in the, am I saying this right?
Yeah,
Did
you're
I get
right.
that?
So it's 14 years before the IBC method um,
Yeah,
starts beating the CD method.
the CD method. And then it's off to the races because every year thereafter, it gets better and better and better. And again, this is why you end up with the $700,000 difference
Yeah,
between the
it gets
between the
better on a
methods.
compounding growth curve, not just a linear curve.
Right. Yeah. Yeah. I I was having a conversation with somebody recently about how the interest that the insurance company is, just say for instance, is 5%, and the growth inside the policy might be, let's just call it 4%. Well, the obviously 5 is bigger than 4, and so if you have a loan out, you're paying interest on that at 5%, and the growth inside the policy is at 4, but the pool of capital that's in the policy at that point, 14 years, it is so much larger. Therefore, the growth is bigger than what the interest is being charged over here for that car that you bought that year. Um, it's just outpacing it. It's getting more efficient. It's almost like that. It is like that. The plane example that Nelson uses, where when they lift off, they get a full tank of gas, 200 miles out, 500 miles out. The efficiency of it has gotten better, and that's basically what's happening with inside the policy over time. So in 14 years, it flip. Yeah, go ahead.
No, you're good. The reason why the infinite banking method takes more time to get off the ground and start taking over the CD method is because with the CD method, you're dealing with a bank, or let's just call it an entity that has already been created and is already being profitable. And so when you're funding that, they're able to give you immediate returns. Now, with the IBC method, you're creating a brand new entity, a new life insurance policy, and there are costs associated with it. Anytime you start a new business from scratch, there's going to be startup costs, and it will take time for those to pay for themselves. But once they do, you're in an ownership position, as where compared to the other one, the CD method, you're not in the ownership position. You're in the depositor and the borrower position, or the withdraw position.
Yeah.
You're not in the ownership position. And so the CD method, you're never going to earn those dividends for being an owner, whereas with an IBC policy, you will earn those dividends for being an owner. It just takes a little while for it to overcome, but once it does, like Raymond was talking about, it explodes in an accelerating fashion.
Yeah. And a lot of times folks don't think about the fact that the bank took years to get to where it is. By the time you show up 15, 20 years later, they have a lot of skin in the game. They've been at it for a while, and they built up some capital. And you're basically starting where they were 15 years ago. You're starting from scratch, and it's going to take you time to build your bank too. But eventually you aren't going to need to go to that other bank because you are going to be the bank.
Mm-hmm.
Yeah.
Yeah, it's so cool. And what's funny is a lot of people, I mean, if you're listening to this is what our 25th episode, then you're probably thinking about what it means to be your own banker. But most people don't, that thought never even crosses their mind. Like,
which thought is that?
That they could be their own banker.
Oh, yeah. Yeah, that's true.
I mean, it never crossed my mind until I read the book, Becoming Your Own Banker. I was a save it type of a guy. Put them in their own designated cash accounts, let them sit there earning their 1%, 5%, whatever it was in between growth in their savings accounts. And, then finance whatever it was that I was financing just with cash. That's how I thought. That's how I operated. And it's just not as efficient.
Right.
It's not as fun either. This to me is fun.
I did the same thing. I would say, my wife and I would save, and then make a deposit on something, buy a new car, here's the deposit, and that money was gone. But hey, that's what everybody does. How else can you do it? So anyway, yeah, it's awesome that we both stumbled on this, because I think most everyone stumbles on it. Yeah. So I'm just looking through the book here. There was something I wanted to mention that I thought was pertinent, but so like I know I'm jumping toward the end of this chapter where he says there are just two hard and fast rules in building and carrying out the concept, and it's to not be afraid to capitalize, or if you want to think of it. Don't be afraid to capitalize, or if you want to just say, don't be afraid to save, if that feels better.
Mm-hmm.
Um, don't be afraid to capitalize, and don't take policy loans or make policy loans until you've decided how you're going to pay it back. But if you're a saver, if you're already saving, you can take the loan and pay for whatever it is that you bought, at the applicable interest, if you will.
Yeah. Yep. And I think in order for me to wrap my head around the power of all of this without just looking at the numbers, and again, the numbers are just whatever, they could be whatever they are, but really understanding the value of what was happening, I had to understand who was who and what they were doing. I never had thought about it that way, but Nelson talks about so many times, he talks about the characters in the play.
Right.
And it's funny because it's really simple when you think about it. I'm just going to read this little paragraph here. He says, let's compare the activity and characters in a conventional bank with that of a life insurance contracted with a mutual life insurance company. A bank can't operate without hired help. Neither can a life insurance company. A bank must lend money or it's not in business, and so does a life insurance company. These two items are a complete wash, right? Both companies
Mm-hmm.
need both things. The
Yep.
stockholder at the bank earns dividends, and so does the life policy owner. The CD holder at a bank earns interest, and so does the life insurance policy owner, guaranteed cash through guaranteed cash value. So the only difference in the two of them, with a bank and a life insurance company, is how earnings are allocated. The life policy owner gets both interest and dividends, whereas the bank, the CD owner, only earns the interest.
Right.
So recognizing who the players are, what their role is really critical. And I know we already talked a little bit about that, but basically, the essence of life insurance, of infinite banking concept, is just recovering the interest that one normally would pay to a banking institution and then lending it to others so that the policy owner makes what a banking institution would make. It's putting you in that
Right.
position of ownership and giving
Yeah.
you the control.
Yeah. There's just to drive that point home. There's another section in the book here where on page 43, the first column, where he says if how's it go? If you have seen an executive vice president of a life insurance company and an executive vice president at a bank, they could change jobs every 6 months and you never know that they did that because they
Yeah.
are so much alike. Period. That's it. Um, yeah.
And then you've got the financial entertainers out there that say life insurance is a bad place to put money. Why is it a bad place to put money? It's privately owned, private contracts between private individuals, and they do literally the same exact thing that banks do. They lend it out for a profit. It's just
Right.
with a life insurance company, you get a little bit more flexibility and a way bigger benefit. You know, one of the things that's not even factored in, you gave them the $705,000 number that the banker makes, or the IBC policy owner makes, as compared to the CD individual. Well, that's not even including the death benefit. We're not here to talk about death benefit, but if someone was to die, if the owner was to die of a CD account, they would just leave their um, leave their beneficiaries with that value that's in the life or that's in the CD account. Whereas the one with the whole life policy designed for infinite banking is going to leave a significantly larger number because we're dealing with death benefit. It's all safer and it's all privately contracted. There's not as much government involvement. Whereas like the yeah, there's just less government involvement with insurance companies than there is with banking institutions, and they can't take
Yeah.
that
Yeah.
dang 30%.
Yeah. Well, and just having if you think back to our forefathers, right? Now, granted, they were probably banks, but I'll bet you there were a lot of things that went on where people saved money. And if somebody needed a loan, they could go to a friend and say, hey, I was wondering if I could borrow a little money because I got to do this. They would set up a contract. And as Nelson calls it, the me, you and me level. You're banking on the you and me level. And if we go back to that, you remove all of the negative, meaning the seed, the person paying cash, the person paying with lease, the person saving up for a car and then draining that savings. In paying the taxes on all of that, any growth that's there, like you just said, you're eliminating all that. Nobody has to know what you're doing all the time, and it's a lot more profitable for yourself and your family. So.
Yeah, I mean, if someone knows what you're doing all the time, then that means that they're probably being paid by somebody to look into all of that, right?
Yeah, and they might want to be Willie Sutton,
Yeah.
and see if there's a way they can get a little piece of that.
Yep. One of the challenges I heard recently was actually from an attorney, and he was saying that you got to stop thinking like an individual. This is an attorney who's also an infinite banking practitioner, and he helps people set up, businesses and trusts and all this kind of stuff to create some degrees of separation, but also to be very profitable in avoiding some of those Willie Sutton types, some of the taxation on things that are rightfully yours. And it's he was saying, in order to do it correctly and to do it profitably, you need to start thinking like an entity. But we've been trained to think like individuals. Individuals get screwed by the system, but entities can create copies and can create more degrees of separation where they don't receive the same kind of tax liability, right? And so that's really what Nelson was saying when he even wrote the dang title, Become Your Own Banker. Think like a banker, think like an entity, a banking entity, and make decisions like they would. So if a bank receives money on deposit, to them, that's a liability. A loan that they loan out to somebody else is an asset. Okay, if that's the case, and I need to think like an entity or think like a banker, then I should be thinking, okay, where can I loan money to get that money into motion and create some cash flow? You're creating assets by loaning money. That's not the way individuals were taught to think.
Right. Yeah. Yeah, and I think that's probably why there's so many folks that come to IBC that are real estate investors when they come to realize what IBC and how to use it within that business of real estate investing. They see the power of it inside this because they're I guess I want to say they're more entrepreneurial and they're thinking in that manner. So, but everybody can, like we talked earlier, we're only one step away of changing the way we're thinking, so everyone has that ability to make that one shift and see the power of it all. But I know we've been talking quite a bit here. I hope we aren't overextending our time, but I think that there's the one last thing I'd like to talk about is we're always thinking about how the policy is growing and it's getting bigger and the cash value is getting bigger and all this other stuff. But at some point, you're going to want to go down the other side of Mount Everest. You're always climbing up, making everything grow, your assets grow and all that. But when you decide that you're going to maybe change your pace of work time, let's call it, and you're going to take more time off, more traveling. And so you start taking your basis out of your policy first, maybe, I'm just saying. There's lots of different things you can do. But the point I want to make is he shows on page 47, and he gets into it a bit. Let's see, where this person starts taking $50,000 a year, and while the person is taking $50,000 a year, the policy at age 72, they start taking it. The policy continues to grow, even at 50,000. And he lives to the age of, in the example in the book, down to 75 years later, at age 95, he's taken out, what's that, $650,000, and he still leaves over $1 million in death benefit. How powerful is that? I mean, I not to crucify 401ks or anything, but can your 401k
go ahead and crucify them?
Can your 401k or your IRA do that? I don't think so.
Well, if you're making the hypothetical 30% year over year, yeah.
Yeah, okay, but now that also throws in, well, what's the tax rate when you decide to start taking that out? Because historically, as we all know, we are in the lowest tax brackets in history right now, and
taxes are on sale,
and we're all complaining now. So, anyway,
seriously, it's hilarious listening to people because, you and I have done a lot more research. You lived through it. I didn't live through it, but I've done a lot of research of economic history of America and everything. And we really are not in that bad of an environment right now, but it was better than it was, quote unquote, for consumerism several years back. And so all the people my age and younger, this is all they've seen, and they are pissed that interest rates are 6%, 7%, 8%. I'm like, this is ridiculously easy compared to what it has been in the past. So quit complaining and maybe increase your level of understanding. And when you do that, it gets scary. You realize what is probably going to come just because history repeats itself. And, then the question becomes, when would you like to have a plan in place? Would you like to have a plan in place now, before you need it, or after you need it?
Yeah, it's kind of like that. It's kind of like that parachute thing.
Yeah,
jumping out of a plane. Do you want the parachute now, or? Anyway, Kyle, this has been great. Is there any ending thoughts that you'd like to share with this?
I would say, don't be afraid. Like you said, don't be afraid to capitalize your system, but also start creating assets. You literally have the power to create assets. You don't have to buy them from other people or anything. You capitalize your system. You create assets by making good loans. That could be to anyone. It could be to yourself. It could be to your mother or to your brother or to a friend, or just out there on the market. You can make loans to third parties if you would like to. Start doing that. You will learn how to wield money. And when you learn how to wield money, you can learn how to make a lot of it. And just imagine what that can do, not just for you, for the people around you, for your church, for your family, for the generations coming after you. When you learn how to do it, you'll impact many, many people. Thank you for joining us on the Sound Banking Podcast. If you're listening on YouTube, make sure to like and subscribe and click on the notification bell. Otherwise, join us on Apple Podcasts and Spotify for more content.